With its open lounges with cozy seating, potted plants, coffee and tech bars, and library, in the new central London commercial property could easily be mistaken for a hotel. Executives in the property industry after the epidemic utilized terms like hotelification and earning the commute to attract back workers who had been working from home. The trend towards hybrid workplaces is widely acknowledged by employers. There have been cases of smaller companies doing away with their physical locations altogether. So, what does the future hold for the commercial property market, and how can businesses adapt to these changes? Let's dive into today's YouNik Economy video. Investors are worried that the property market is on the verge of collapse due to rising borrowing rates, slowing economic growth, and a decrease in the number of people working in downtown office buildings as a result of the epidemic. Some city investors are concerned that if banks reduce lending to the commercial property market, which is worth $33 trillion globally, the next phase of the crisis could pile pressure on the market. Silicon Valley Bank's failure was the largest banking failure since 2008. UBS rescued Credit Suisse was also in the news, as the US Federal Reserve hiked rates by a quarter point to a range of 4.75% to 5% last week. The Bank of England raised its base rate for the 11th time in a row to 4.25%. In an effort to rein in inflation that has refused to budge despite previous efforts. The European Central Bank to increase its deposit rate to 3.25% by mid-year, from 2%. The next target may be a commercial building housing offices or stores. The market for commercial real estate is a source of worry. It will be interesting to see how the real estate market and lenders react to the new, higher borrowing rates for property developers. From a low of 43% in June 2022, European office occupancy rates have risen to 55% in February 2023, though this is still lower than the pre-pandemic average of 70%. According to data from Remit Consulting, the usual pre-pandemic occupancy rate for offices in the United Kingdom was between 60% and 80%, but as of 2023, the figure was only 34%, and much lower in London. The most recent data from the Office for National Statistics shows that, compared to before the epidemic, almost 40% of working adults in the UK now work from home at least one day each week. Office occupancy is often greater in the middle of the week, whereas Mondays and Fridays see a disproportionately high number of people working from home. Companies should prepare for the fact that Fridays will be quieter than other days. Central London's market is substantially more volatile than those of other UK cities since it is so strongly related to worldwide trends and global economic performance. Considering these factors, the decline in UK commercial property values is maybe not so shocking. According to CBRE's UK monthly index, commercial values increased in the first half of 2022 before falling between July and December. The outcome was a yearly drop of 13% in property values. Blackstone Real Estate Income Trust is just one of many property funds that had to restrict redemptions in recent months as investors cash out. Concerns about the banking sector's current stress spreading to the commercial real estate sector have increased. As investors have been pulling money out of property funds in recent months, Blackstone Real Estate Income Trust is just one of many. Although compared to the US, where troubled regional banks were the key providers of financing for commercial real estate, the commercial real estate debt market in the UK appears to be in a stronger situation. Yet in the United States, tiny regional banks fund a disproportionate amount of real estate loans, which is not the case in Britain. No UK banks have failed as of yet, and only accounts for 6% of total debt, down from more than 12% in the years leading up to the 2008 financial crisis. Capital values for offices have decreased by 15% since 2018, compared to a fall of 11% for all buildings, and refinancing will become more difficult as credit conditions tighten globally. Certain owners of commercial properties like stores and distribution centers worldwide may be obliged to liquidate holdings when existing loans reach maturity if interest rates continue to rise. This might prolong the real estate slowdown and slow the recovery of commercial investment. Rising interest rates caused by runaway inflation have a significant impact on the future for the commercial property market. If inflation continues to climb, we are going to end up with higher base rates. Inflation in the UK spiked to 10.4% in February, in New Zealand 7.2%, Australia 7.8%, which is much beyond market expectations, but is likely to decline later in the year along with US and Canada. As a result, investors believe that the current cycle of base rate increases by the reserve banks of the world has reached its top, which should ease concerns about the commercial property market. As we wrap up today's episode, it's clear that the commercial property market is facing some significant challenges. The rise of hybrid workplaces and the recent increase in borrowing rates have caused some investors to worry about the market's future. However, there is still hope for a recovery. With inflation rates expected to decline later in the year, and reserve banks potentially easing up on base rate increases, some investors are optimistic about the future. And as businesses continue to adapt to changing workplace trends, we may see new opportunities for the commercial property market to thrive. Thanks for tuning in to YouNik Economy. Be sure to subscribe to our channel for more insights on the latest developments in the world of business and economy.